All right, so you want to trade like the pros, huh? Well, buckle up, because this deep dive is all about institutional order flow. We're talking about the big players, the ones betting the real money, and how they see the market.
And trust me, it's not about finding that one magic indicator.
Yeah, we're going deep on a video from the Inner Circle trader, and he basically says, forget those holy grail setups.
He calls it religion, not reality.
It's like he's saying, get real, folks. Institutions don't play that game.
Not even close. They're not looking for some secret pattern. They're looking at us.
Us. You mean retail trader.
You got it. He even uses the word cannibalize, which sounds kind of intense, I know.
Intense is an understatement. So is he saying they're out to get us specifically?
Not exactly. It's more like they're playing a different game entirely. See, most retail traders, we tend to get emotional. We chase trends, get greedy, or panic when things get bumpy. Institutions, they see that.
Ah, so they use our own emotions against us.
Exactly. They have the algorithms, the information, the resources to see those patterns of behavior and, well, capitalize on them.
Okay, it's starting to get a little nervous now. But if they're not relying on patterns, what are they looking at?
2 words. Liquidity pools. Big chunks of buy and sell orders just waiting to be tapped. Institutions know how to spot them, exploit them. It's how they make those big moves without making a big splash, at least not at first.
So they're playing the market like a game of chess while we're stuck with checkers.
That's a great way to put it. They're thinking several steps ahead, anticipating our moves, and using the market's own mechanics to their advantage. And a huge part of that is timing, which he says most retail traders completely overlook.
Timing? Like what time of day it is? How does that even factor in?
It's all about the algorithms. See, a lot of these algorithms, they operate on cycles, almost like they're working off a schedule.
Okay, this is where it starts to sound like a sci-fi movie. Algorithms, secret schedules, institutions exploiting everyone.
It's all connected. And understanding how these algorithms work, well, that's the key to understanding how institutions manipulate the market.
Okay, so algorithms running on schedules and institutions using that knowledge.
Yeah.
I'm starting to see how this all fits together.
Right. It's like cracking a code, but instead of secret messages, it's market moves.
Yeah. And speaking of codes, this expert kept mentioning something called the bearish ICT Fair Value Gap, which honestly sounds a little intimidating.
Yeah, the name's a mouthful. I'll give you that. But it's actually a pretty simple concept, just a visual pattern that pops up on the charts.
So less like a secret code, more like a secret symbol then. Like a bat signal for institutions.
You got it. Think of it this way. Imagine you're walking down a busy street, people everywhere, kind of random.
Yeah, just a normal day in the city.
Now imagine a street performer sets up and a huge crowd gathers. Suddenly, you've got this gap in the normal flow of people. That's kind of what institutions do in the market.
They create these gaps in the normal buying and selling. So the fair value gap is like spotting that crowd around the street performer. It's showing us where the institutions might be.
Exactly. It's not some magic formula. It's about understanding how these big players distort the market and how we can read those distortions.
And he actually showed how this plays out in real time, using the Nasdaq as an example. Though I'll admit, when he started talking about 15-minute charts and then zooming into the 1-minute interval, my head started to spin a little.
It can seem overwhelming, but the key takeaway is that this isn't just about predicting if a move is going to happen, but potentially the direction of the move and even how far it could go.
Yeah, the part about setting stop losses and profit targets based on this fair value gap, that's what really blew my mind.
And that's where the real power comes in. He even talked about using something called internal and external range liquidity to pinpoint entries and exits.
Okay, I'm going to need you to break that down for me. What is internal and external liquidity?
Sure thing. Think of it like this. Internal liquidity is the stuff inside your house. You know, it's there, it's accessible, but not that exciting. External liquidity, that's like that awesome news store that just opened across town. Takes a little more effort to get to, but could be worth it.
So institutions, they're looking for those stores across town. They want the external liquidity.
Bingo. See, those external pools often represent price levels where a lot of traders have set their stop loss orders, like those mental barriers where if the price goes beyond that, they're out.
Ah, I see. So if institutions can push the price past those stop loss levels, it's like a domino effect, right?
Yeah.
Triggers a cascade that drives the price even further in their favor.
Exactly. And that's why understanding this stuff is so powerful. Institutions aren't just reacting to the market, they're actively shaping it. But the good news is they leave clues. It's like they're whispering their secrets. We just got to learn how to listen.
It's like we're learning a whole new language, the language of institutional order flow.
And just like learning any language, it takes time and practice. But trust me, even a basic understanding can give you a massive edge in the market.
This is incredible. I have to admit, I'm a little overwhelmed, though. How do we even begin to put this into practice? It feels like one thing to understand it in theory, but actually applying it in the real world, that's a whole other beast.
Absolutely, it's a journey, right? Like learning any new skill, it takes time and practice. But the good news is you don't need to be some kind of order flow master to start benefiting from this stuff.
So where do we start then? What's step one in becoming what was it you called it? A market detective.
That's it. And every good detective knows it's all about observation. Start by just looking at the charts. Can you see those disruptions? Can you spot those fair value gaps? Don't worry about making any trades yet. Just get used to seeing the market from this new perspective.
So really training our eyes to see those footprints, those traces the institutions leave behind.
Exactly. And forget about those complicated setups and indicators. Start with the basics. Remember those liquidity pools we talked about? Think about where you find the major support and resistance levels on your chart, because that's usually a good place to start looking for those big players.
Because those are the spots where institutions know they'll find the most orders to work with, right? It's like fishing.
Exactly. You're not just going to cast your line anywhere, right? You're looking for the spots where the fish are most likely to be.
So the better we understand where those fish are, those pockets of liquidity, the better we can anticipate those institutional moves.
It's like anything else. The more you do it, the more natural it becomes.
This whole deep dive has been amazing. It's like we've been looking at the market through a straw this whole time, and now someone's finally given us the whole picture.
And the best part is, this is just the tip of the iceberg. There's always more to learn.
Well, I think that's a great place to leave it for today. If you're ready to ditch those holy grail setups and see the market from a whole new perspective, this is your sign to start exploring institutional order flow. Keep those charts open, and as always, happy trading.